All right, let's dive right in. If you're advising high-income retirees, you know that one of the biggest, and let's be honest, often most unexpected costs in retirement is Medicare. Today, we're going to go deep, really deep, into the mechanism that drives that cost, the 2024 Medicare Income-Related Monthly Adjustment Amount, or as we all know it, IRMAA. Understanding this isn't just important, it's absolutely critical for any kind of effective retirement planning. So let's get into it.
So, here's our game plan. We're going to break this down into 6 key parts. First, we'll look at the legal foundation. Where did IMAR even come from? Then, we'll get into the real nitty-gritty of how income is actually calculated for Medicare. After that, we'll run through the hard numbers for 2024, expose the biggest traps in the system, and then, most importantly, walk through the exact strategies you can use to help your clients navigate this whole thing.
Okay, first up, the Statutory Foundation. You know, to really get a grip on how IRMAA works today, we kind of have to go back and understand its origin story. You see, IRMAA wasn't just created overnight. It was built piece by piece over about a decade by 3 major laws. It all started back in 2003 with the Medicare Modernization Act, which first introduced this idea of means testing for Part B. Then, in 2010, the Affordable Care Act came along and not only expanded IRAA to Part D drug plans, but also froze the income thresholds for years. And finally, MACRA in 2015 came in and made the brackets for the highest earners even tighter.
And if you want to know the legal heart of all this, here it is, Section 1839I of the Social Security Act. This is the core legal authority. It basically says, you know that standard deal where the government covers about 75% of your Part B costs? Well, for higher earners, that subsidy gets reduced. It's the law that forces them to pay a much bigger slice of the pie.
So, that brings us to Section 2. And this, my friends, is where the rubber meets the road. We're talking about how to define Medicare MAGI. This is the engine that drives every single IRMAA calculation.
Now, if you take away only one thing from this section, let it be this. Medicare MAGI is its own unique animal. It has a very specific definition, straight from the Code of Federal Regulations. It is a huge, massive mistake to think this is the same MAGI you'd use for, say, a Roth IRA contribution or an ACA subsidy. They are not the same thing.
So, how's it calculated? Well, the formula starts out looking pretty simple. You take the adjusted gross income, that's line 11 on the Form 1040, and then you add back any tax-exempt interest from line 2A. That's the baseline. But notice, this is all happening before the standard or itemized deductions. So things like your client's big charitable contributions, they don't reduce this number at all.
But wait, there's more. The regulations, specifically 20 CFR 418.101, they mandate several other add-backs. We're talking about income that's normally excluded, like foreign earned income under IRC Section 911, or certain territorial income, and even interest from U.S. savings bonds that was used for education. All of that gets added back into the pot. And this right here, this is one of the biggest gotchas in the entire system. It's the 2-year Lookback Rule. The Social Security Administration doesn't use last year's income. For 2024 premiums, they're looking at the 2022 tax return. And this data lag is exactly why so many new retirees get a really nasty surprise in their first Medicare bill.
Okay, which leads us perfectly into Section 3, the numbers. Let's pull up the official surcharge tables for 2024 and see exactly what we're dealing with, all based on that 2022 Medicare MAGI. Right. For individual filers in 2024, the base Part B premium is $174.70. But if your 2022 MAGI tipped over $103,000, the surcharges kick in, and you can see they ramp up fast. For instance, if you were between about $129K and $161K, you're paying double the base premium, and it just goes up from there, topping out at a monthly premium of almost $600.
Now, for couples filing jointly, you can see the thresholds are just doubled, starting at $206,000. But here is the absolutely critical point. That IRMAA surcharge, it applies to each person. So that first-tier surcharge of $69.90 isn't for the couple. No, it's per person per month.
And now, take a look at the brackets for married filing separately. This isn't a mistake. It's designed to be punitive. The law is set up specifically to stop high-income couples from trying to game the system by filing separately. If your MAGI is just $1 over $103,000, boom, you're immediately launched into the second-to-last surcharge tier.
paying $559 a month. The Part D surcharges are a little smaller, but they follow the exact same MAGI brackets. And the key thing to remember here is that this amount is an add-on. It gets tacked right on top of whatever premium your client is already paying for their private prescription drug plan. So all these numbers bring us to the two biggest systemic risks that you have to plan for, what's known as the cliff effect and that 2-year data lag we talked about.
To really understand the cliff, let's just ask a simple question. Let's say a married couple filing jointly had a 2022 MAGI of $206,001. Just one single dollar over the line. What happens?
Well, the answer is their total annual Medicare Part B premiums go up by $1,677.60. That's the $69.90 surcharge times 2 people for 12 months.
I mean, just let that sink in. That single dollar of income triggered a nearly $1,700 cost increase. If you do the math, that's an effective marginal tax rate of over 167,000% on that $1. This isn't a gradual tax bracket. It's a hard, unforgiving cliff.
So how in the world do you deal with this, especially for a client who just retired from a high-paying job and their income is about to drop significantly? Well, that leads us to the primary remedy, requesting a new determination because of a life-changing event.
Now, you don't get to just make one up. The Social Security Administration's own rulebook, their POMS manual, defines exactly 8 and only 8 qualifying events. And this is the complete list. It's got the ones you'd expect, like work stoppage for retirement, marriage, divorce, death of a spouse, but it also includes some less common ones, like losing income-producing property. But here's the key. Just having your investments go down or a general drop in income, that's not good enough. It has to be one of these 8.
Okay, let's bring it home with our final section. How do you actually put this strategy into motion? It all comes down to one form, the SSA-44.
Filing Form SSA-44 is actually a pretty straightforward process. You pick the specific life-changing event from that list of 8, you provide the date it happened, and then, and this is super important, you give a good faith estimate of what your MAGI will be for the current tax year. Now, the catch is that income drop has to be big enough to actually bump you down into a lower IRMAA tier. If it doesn't, they'll just deny the request. And of course, you have to attach all the paperwork to prove it.
And just one final point of clarification, using Form SSA-44 for a life-changing event is technically called a request for a new initial determination. This is a totally separate path from the formal appeals process. An appeal is what you'd use if you think Social Security just got the facts wrong or made a math error, not because your life circumstances have changed.
So there you have it. We've gone from the law that created IRMAA to the nitty-gritty of the MAGI calculation, the 2024 tables, the dangerous cliffs, and the escape hatches. So the final question, that's really for you. Now that you know the deep mechanics and how unforgiving this system can be, where are those precise opportunities for MAGI management in your client's plans before the year closes out?